Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to this special edition of Standard Chartered Money Insights. This podcast is a part of a mini-series surrounding our 2022 outlook, which was released last week. Our theme for the coming 12 months is a winding road to normality. Today, we'll be talking about our sector preferences within equities across three regions, the US, Europe, and China. My name is Steve Brice, and I'm the bank's Chief Investment Officer, and I'm fortunate to have with me Fook Hien Yap, who is a Senior Investment Strategy and holds the key to unlocking all our sector views as he heads the CIO Office's Sector Investment Committee. Fook Hien, good to have you on board. So maybe if we're just looking at the sectors, can you just sort of summarize what your key sector preferences are, please?
Yeah, thanks very much, Steve. Very happy to be here. So we look at sector preferences for three main regions, as you mentioned. That is the US, Europe, and China. And our main sector preference in the US and Europe is the technology sector. While for China, our key preference is the industrials sector.
Okay, so let's talk about the US. Technology's already had a pretty good run, actually, pretty much for the last 10, 11 years, right? So hasn't it done very well already, and therefore it's going to underperform?
Well, you're right, Steve. Technology over the long run has done very, very well, and we are picking our moments here. So if you look at 2021, actually, technology, if you plot the chart against the market, it hasn't done that well up until Q3 2021. So up until the end of September, technology in the US has actually been underperforming the US market. But in Q4, it really outperformed and rallied. And so year to date so far, we're looking at tech sector in the US having outperformed. And we think this will continue. And that's why we've upgraded tech to be a preferred sector now. The US is moving beyond an early recovery phase now. So in the early phase, you see some other sectors outperforming, but it's moving beyond that now. We think at this stage, the tech sector's resilient growth will shine again. We do expect higher volatility in 2022. This could come in the form of your potentially new COVID variants, and that could cause volatility. And in this kind of market environment, the tech's resilient and structural growth will really help it. So the growth innovation themes that we like are like your Internet of Things and 5G, your cloud computing, and your digital interactions. So all these are supportive of growth in the tech sector. And there's also strong cash flows, and the margins we expect, the profit margins we expect will be very resilient for the sector. And this is going to help support your share buybacks. Again, a good tailwind for the tech sector.
Okay, so I suppose that's a good segue also into Europe. So technology is one of your preferred sectors there. Can you sort of talk about that and any other preferences you have in the region?
Yeah, thanks, Steve. So in Europe, technology is slightly more cyclical than in the US. This is because the semiconductor industry in Europe has got over 40% of the tech sector in Europe. But we think semiconductor is very well placed right now. The industry has facing chip shortages. You've got a cyclical demand that is very strong with a cyclical recovery that we're seeing right now. But structurally, demand is also very strong. And these are from trends like your 5G upgrades, your cloud computing, Internet of Things, artificial intelligence, and electric vehicles, which are using more and more semiconductor chips. So because of this structural demand on top of your cyclical expansion, we think there's shortage in terms of the chips. This could be prolonged. It could extend to the second half of 2022. So the tech sector is going to be supported by your semiconductor industry. So we do like the tech sector in Europe. The other preferences, the sectors that we have in Europe are for financials, consumer discretionary, and industrials. Now, I've just run through them briefly. So financials is relatively cheap compared to the market. And we think that the higher bond yields that we're going to get as it nudges higher, that's going to be a supportive tailwind for financial sector. There's also attractive dividend yields there and share buybacks to help the sector's stocks. Consumer discretionary is one we've just upgraded to be preferred in Europe. We see it recovering from consumer spending as your reopening continues in Europe. And the autos is also 25% of the discretionary sector in Europe. And we do like the way the auto companies are pivoting towards electric vehicles. That is a growth theme that we like. We think that will support the discretionary sector. Industrials in Europe will benefit from the green transition capex, government's infrastructure spending, and inventory rebuild. And it's also exposed to your transport-related assets that will benefit from reopening. So the four sectors we like in Europe, as I mentioned to recap, is technology, financials, consumer discretionary, and industrials.
Okay, thanks, Fook Hien. And then let's move on to China. Obviously, it's very, very important to many of our clients in this part of the world. So what are your sector preferences there?
Yeah, with China, regulatory policies are the dominant driver, and we think that continues to be the case. So with that in mind, we have industrials as a preferred sector. We think industrials are aligned to policymakers' goals. The government wants to increase the hard manufacturing expertise within domestic China. And this means expanding your expertise in your supply chain and infrastructure for growth industries like your electric vehicles and also your green economy related equipment manufacturing. There's also the reopening element that will help the industrial sector in China because transport related assets are about 30% of the sector. And as mobility improves, we think that will help support the industrial sector in China as well.
Okay, and a lot has been made of the consumption theme in China. So what are your thoughts in this space?
Yes, we've also just moved consumer discretionary in China to be a preferred sector. Now, we are aware that the internet companies within the discretionary sector, they have been out of the favor, but we do expect negative earnings revisions for these internet companies to bottom out. And the regulatory intensity, we expect that will moderate, even though your reforms are still ongoing and still being implemented in the sector. As the intensity moderates, we see the earnings bottoming out. Household income is still growing, and that's going to be supporting your consumption growth. So we think this is going to be helping the discretionary sector, which has seen a lot of bad news already priced into the sector. Also, autos is about 20% of the sector, and they're pivoting very strongly to electric vehicles in China. That is a growth theme that we do like, and we think that will support the discretionary sector.
It's very interesting, Fook Hien. Thank you so much for chatting with me today. That is all we have for this special episode of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcasts. Thank you for joining us and enjoy the rest of your day. Stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.